in my business model is that I just believe everybody should have a dignified place for their head to hit the pillow every night. And believe me, there's a lot of stuff out there that just doesn't meet that standard. So with my architecture and construction background, it was kind of a natural segue for me to want to get into the space and start executing these types of turns. And we do some pretty nice finishes. I've taken many D and F class buildings and turned them into a solid B. Condo quality finishes. I mean, they're really nice places to come home to at night.
Hey guys, let me tell you about Folio Lands. We landlords fear complaining tenants, fast turnover, bad reviews and negative ROI. Over the years I realized it happens because we lack a system. They streamline maintenance and repair requests by inviting our co-investors and repairmen into the app to foster smooth communications between us, the tenants and the suppliers. Head over to foliolens.com if you hate time-consuming admin tasks like tracking your property revenues, expenses, and due dates. So sign up for their newsletter at foliolens.com and start managing your rental properties from anywhere in the world. Welcome, Mark and Josh, to the Ideal Investor Show. I love that you could make the time in the new year to come to us and help us learn a little bit more what you do, how you became successful to the extent that you are, and what your story is. And with that being said, I would like to ask whoever wants to go first to maybe introduce yourselves a little bit and tell us where you are, what you do, and where you're coming from.
Sure. I guess I'll kick it off. Hi, everybody. My name is Josh Welch. I'm the founder and managing principal of Three Pillars Capital. We're a private equity firm here in Houston, Texas, and our sole focus is on finding value-add multifamily deals. Our current portfolio is about 300 million in assets currently, and we've grown that, from scratch basically over the past 5 years. So we've done, very, very well with that. But we didn't just make it straight to the big leagues. We started out small. We had a lot of kind of growing pains along the way, a lot of things that we learned. My background, I have an engineering background, so I'm able to use a lot of the quantitative analysis, a lot of the intricate problem solving abilities to have formed this company. And I guess I'll say that our focus really is on taking these underserved communities and workforce housing type communities and really making them a place where people want to live. And obviously it's a great return for our investors because we can create significant value by updating a lot of these usually older vintage assets and then getting a lot of rent appreciation on top of that. And obviously good returns for investors, but we're making these communities much nicer places to be. Our residents at least where our communities are, they don't have to just take the guy next door who has a pretty crappy beaten out apartment with 10-year-old carpeting. They can go to us and have really nice luxury looking unit for just $100 or $200 more. So that's kind of the intangible factor for me, giving people a great place to be, but also kind of the ashes to beauty type of things. That's what makes it fun for me.
So it's basically Josh, the Phoenix version. All right. How about you, Mark?
Yeah, I'm Mark Shuler, and I am a practicing architect in Seattle, Washington. I, too, have my own private equity firm focusing very much on the same asset types as Josh. I've always been in the sort of C, B minus sphere, have renovated hundreds and hundreds of apartments over the last 10 years. And found that a lot of the goals and processes that Josh just outlined were very similar to my own. So we've been kind of joining forces for the last 4 or 5 years now, doing deals together. I think we've done like 8 deals. And we just kind of reinforce what Josh said. I just like the workforce housing play. I think there's a lot of really beat down assets out there that could really use a facelift. And part of my core value in my business model is that I just believe everybody should have a dignified place for their head to hit the pillow every night. And believe me, there's a lot of stuff out there that just doesn't meet that standard. So with my architecture and construction background, it was kind of a natural segue for me to want to get into the space and start executing these types of turns. And we do some pretty nice finishes. I've taken many D and F class buildings and turned them into a solid B. Condo quality finishes, quartz countertops, vinyl plank flooring. I mean, they're really nice places to come home to at night. And our investors kind of like the returns that we provide for them. And, it's just a really complicated and multifaceted business model, but both Josh and I are basically engineers in life, and we thrive in complicated problem solving. So
That's right. That's why we get along so well.
Yeah. I think so. It also helps for Michiganders, and we both went to U of M. Go.
Oh, yeah.
So
we won't talk about what happened a couple of weeks ago, though.
Yeah, well, Georgia did win the national championship, so we held them.
Yeah.
You guys got much closer than recent years, right? So,
Well, I'm a little older than Josh, so I graduated before he was probably out of diapers. But anyway.
Before we talk a little bit about those categories and those improvements, you said it makes good money for your investors. Can you give a little bit description who the investors are? Do they need to be in Houston or in Seattle, or can they be anywhere? And what would be the things that if somebody listening to us would say, so they're taking something that is kind of rundown and make it really nice. And a lot of people who listen to our show or read what I'm writing, I'm always talking about, turnkey investing, turning things around, making them better. So I think there's great alignment, but I'm by no means an expert on how this works on a larger scale apartment complex or stuff like that. So could you maybe first start out a little bit on who would be an investor that you would be working with? What would be the criteria? Who would they be? Where would they be?
Sure. So, all of our deals were we find the deal, we run it, we renovate it, we eventually sell it, and that's where everybody makes the money. So we're basically the general partners and in charge of the whole thing. So our investors are all passive. In fact, I think it would be too many cooks in the kitchen if we tried to incorporate investors into our operations. So basically, we run the show. We send quarterly reports to all of our investors. They get distributions every quarter along the way. And we try to make it very easy for them. So you don't have to have any experience. It doesn't take any real estate knowledge at all. I mean, some baseline knowledge would be helpful, but it's not necessary to invest. There's no set requirement or skill set that somebody would have to invest in our deals.
And would you, either Josh or Mark, call what you're doing kind of a form of syndication, or how would you describe it?
It's exactly what it is. It's a syndication model. Follow up with what Josh said. Having too many cooks in the kitchen it just doesn't work. And given what we do and just the voluminous moving parts and pieces, it's not really for the faint of heart. You really have to know what you're doing. You have to build up slowly to this, or have professional skill sets like I do that allows me to kind of get out on a job site and direct traffic. But the model that we've built is far more than that. I mean, it's a vertically integrated company. So not only are we the sponsors of the deal, but we're the asset managers. We'll manage it after it's renovated, but we're also the contractors. And so it's this big vertically integrated company, and it allows us to squeeze efficiency out of our business model, which is key to a couple of engineers. We're just looking for every way we can to economize on the whole model so that we can up the returns to our investors. It makes us very competitive in the marketplace too, compared to other syndicators.
Right, understood. And maybe dwelling a little bit on that vertical integration, could either one of you maybe give an example on how that would compare if you were to take like a project, I don't know, like a 50 unit or 100 unit project done with your way versus what people would maybe find from others where the vertical integration is not as tight?
Sure. So just to kind of give a top level picture. So, there's a lot of people in this space, a lot of sponsors, apartment owners that will piece it out and they'll third party a lot of the operations or the onboarding. And there's a lot of people who have been very successful with that. Some examples are the property management. Your money is really made on the ground. If the property is not run correctly, it won't make money. It'll be very difficult to make money. And we've actually bought a lot of assets because they were mismanaged. And so we got a good deal on them and, obviously fixed some things on the ground so they ran well. But that's a piece that's contracted out. Obviously on the buy side, there's a lot of activity, the paperwork you got to get together with the attorney, the accounting that has to get involved, the communicating with investors. There's third-party solutions for all that. And, in the beginning, we tried to do all that. We tried to source it out, but we found very quickly that, one, nobody cares about your business as much as you do. Secondly, we could do it better with enough willpower and tenacity and some brain power, and that's what we did. So some scraped knees along the way, we fell down a couple of times. And so a lot of the vertical integration piece came out of necessity because we had to figure out how to do it better and outsourcing wasn't working. And so we formed Green Line Management, which is our in-house property management company. where we could control the quality, like Mark was touching on earlier. We could control the efficiencies. We could make sure that we were keeping costs down so that it maximized the return. And every time you outsource something, there's a middleman somewhere in there and he takes his cut. And so hopefully you get the same product at the end of the day, but you're paying a little bit more for it. So with us, because we're bringing all the management in-house, including the renovations, we're able to cut out a lot of that fat, and that goes straight to the bottom line for us. And again, like I said, the efficiencies and the quality just skyrocketed for us. So it was a much needed thing, and I'm glad that we took the work and the time to make that happen.
Yeah, absolutely. I think that makes total sense. And maybe, Mark, I can ask you, Josh used the word control quite a bit, and I use this when helping and advising our investors for the smaller scale residential turnkey model as well. What would you say from what Mark just described, how important is having control over these moving parts?
Oh, I think it's the whole business model, personally. Not having to shop this out to, for instance, a third-party contractor. I mean, our guys, we can just point and shoot and tell them where to go. Whereas if we have something that goes wrong in the field, we'll call a contractor. If we were third partying this, we call a contractor and maybe they'll show up in 3 weeks, and we just don't have that kind of time. I mean, our business moves at the speed of money. And so when we have to get something done, it's just really nice to have all the in-house horsepower there to be able to just kind of redirect on a dime some labor going over to this project as opposed to that project today. And just to touch on the efficiencies that Josh was describing, I mean, the bottom line, it's incredible how much I think we deliver 5 to 6 points to our bottom line. And that's straight to our investors. We're just putting money in their pocket. There is some real world return on all of this efficiency and vertical integration that a lot of other syndicators just can't compete with us. We're doing 20 IRRs on all our deals right now. It's getting tougher to do that, but that is not the standard. I'll tell you that right now. That is not what you see from a lot of syndicators. And,
not these days.
Yeah, all our deals, we design them the same way. We look for a certain type of deal that fits our parameters, and we'll see what the next 2 years hold with this inflationary environment, whether we can maintain that or not. But so far, so good.
Well, if all the inflation goes to paying people's wages, then you can have much better rents, right?
Well, there's that, but I think we're turning our units for half of what other syndicators when they third party it. It is
easy.
A lot of savings that we are realizing on our turns. And we're doing 16 to 18,000 a door on a turn. At somebody else's cost, that's 35 to 40,000 a turn. Right. You can't make money when you spend that kind of money on a turn. You just can't do it.
Yeah, and that's understood. And I think that's really an important part. One thing for those who are not necessarily that familiar with syndication, at least in most cases that I have reviewed, you guys wouldn't just be kind of like operators, right? You're not just like a management company. In most cases, there is some skin in the game. I don't know how much you have yourself, but when you're talking about investors, and it's not just because of your generosity or because you're nice guys or anything like that.
Well, we are.
You are. Otherwise, you wouldn't be on the show, right? But fundamentally, in most syndications, yes, you are the general partner, general managers, but is it true? I mean, am I just making it up, or is it true that you are the operators, general partners, but typically also, at least to some extent, part of the investing group?
Oh, yeah. Well over $1 million of my own money across our portfolio. And I put a lot of money in every deal. We do syndicate a lot of the down payment and some of the rehab, but we definitely have skin in the game. The other important part about the syndication model is the alignment of interests. It's an overlooked point by a lot of investors, but not every syndicator will do that, where the investor gets paid before the sponsor gets paid. That's how we structure our deals. And then what that does, it keeps us honest because we're motivated to make money, one. And two, if we're ever going to get paid, we got to make sure there's enough meat on the bone to pay the investors first and then us. So it's a way of keeping the sponsor honest, which is probably for somebody who's just getting into the game, they wonder about that. That's a really important check you can make on an offering from a syndicator is like, where are their interests? How does a waterfall model work? Who gets paid when? I know in our case, we're sort of pathological about making sure that our investors get paid before we do. So,
yeah, that's very good. And one thing, maybe what we could do for anybody who is listening to us and says, hey, that sounds interesting from a conceptual point of view, but it might be helpful if either one of you or both of you together maybe take a current project that is not completely sold yet, where you would say, okay, so here's kind of like what we're working on. And this would be what, if somebody wanted to join as an investor, Do they need to be accredited or not? And how much would they have to actually put in and for how long, and a little bit of that magic?
Sure, I guess I'll tackle this one. It's a little bit of a curveball question, only because there's some SEC rules I can't violate. But anyways, so I'll tell you what I cannot say, but I'll tell you what I can say. So what I cannot say is if there's a deal we're working on, I can't publicly broadcast
I'll take one that closed already, if that's easier. It's just so I would like our audience to have an idea. Okay, if I love what Mark and Josh tell us, how do I get in the door?
Sure. I mean, the good news is all of our deals are pretty much structured exactly the same way. The return profiles are the same. The assets are pretty much the same. There was a deal that we just closed on back in November of last year, so just a couple of months ago. It was 307 units here in Houston, Texas. And that particular deal, it's called La Estancia Apartments. The renovation plan on it is 2 years. So basically from day one until 2 years later, we're renovating nearly 100% of the units. And it's pretty aggressive. A lot of people don't do that. Our model is we want to renovate as much as we can because the faster you can renovate, I mean, it's pretty simple logic. You can get those rents up as soon. It's like a light switch, right? You renovate a unit. Well, the next day, theoretically, you can lease it out for whatever your rent bump is. And you do that times all the units on the property. Well, you've just added 50% to the cash flow.
Right. Are you guys letting people come to the end of their lease and then you don't renew until you renovate it? Or do you basically make a big shift when you take ownership?
We kind of do a combination of both. A lot of it is natural move out. So we find that the ebb and flow of a property per month, we can get about 5% out.
Yeah.
Now, so, there's things we can do like just not renew leases, or we can offer people specials to transfer into a renovated unit. We do that quite a bit, which works well. So it kind of keeps the bodies moving through the vacant units that we need to renovate. Anyways, but just to wrap up, so once we get done with 2 years, there's usually a refinance event where our investors receive a large return, sometimes 50% plus. And then we hold it for another couple of years till about year 5 where we sell it. And, on average, we've usually about 20 IRRs. Our target is usually to double investors' money on every deal. So if you invest, say, $100,000 5 years later, our goal is to make sure that you get a check for $200,000 on closing day.
And so the trigger is probably mainly appreciation, right? It's not if you happen to have a property in an area that like I had some that I never bought for appreciation, but they happen to appreciate by 12% a year, several years in a row. That gets you probably to that point faster than anticipated, right?
Sure.
Yeah, but what you're describing, Axel, that's actually external to the forced appreciation model that we're doing. If you can buy in an appreciating market and do forced appreciation, that's called a millionaire maker.
No, I meant it more in the sense if you say, okay, well, if we reach the 100% point instead of 5 years and 3.5 years, would you then trigger, or would you just say then we just...
Oh, I see. We recently had a conversation about that because that's exactly what happened on one of our properties. And you're sort of in a bit of an ethical dilemma because we have to think in terms of what's in the best interest of our investors. And we were like, holy moly, we've reached the 5-year mark in 27 months. What do we do? And so we ended up pulling the trigger on a sale. You maintain the IRR, but you don't quite get to the 2 times equity multiple because you need the last 2 or 3 years of cash flow to give you the 2x multiple. So it was kind of an interesting dilemma. It's the first time it's ever happened to me in my career. So Josh, you want to add anything to that?
Yeah, I mean, it's really the bottom line is the velocity of money. Mark, I think you said it beautifully earlier. If you're an investor and you invest $100,000 into something and you get 150,000 back in 2 years versus you're expecting to get 200 back in 4 years, well, yeah, maybe you didn't get the return, but you can then launch that money into a new investment. Now you've got $150,000 buying power to do the same thing.
Right.
So it actually will compound faster because it's about the velocity of money. So there's 2 ways to look at it. You can de-risk it and hold it for longer, or you can get the money back with a little bit less return and use that buying power to buy, do more. So it's a win-win either way.
Yeah, and that's actually a beautiful segue because we are still at the beginning of the new year. And at least that's my philosophy. I don't know if you guys agree with that, but anybody who seriously wants to be in real estate investing, whether it's through syndication or direct ownership or turnkey model or whatever approach. But when you take an asset like real estate, I think you, in a sense, commit to say this is a longer term commitment.
Yep.
Not necessarily on the individual asset, but what's the underlying goal, right? And so when we're coming into the new year, and I said that before we started officially recording, if I want to reach a certain, for example, passive income goal, right? then increasing the velocity of money, like you were just saying, Josh, is just getting me a little faster than anticipated and a little closer to that goal. So maybe I put in 100,000 and could barely, or let's say 50,000 in 2 deals. Now I get 150,000. Now I have 3 deals potentially with you or with somebody else that can make money. And out of that, 3, 4, 5 years later, I get my 2x, and now I can do 6 deals, and each and every one has a certain performance that ultimately gets you to what I call the time freedom point, where you can say, okay, now I'm generating enough passive income to no longer have to worry, how do I exchange time for money or have a job or anything like that, right? So always keeping that bigger picture in mind. Now, one of the things that I think oftentimes can get a little bit, and there's this guy Cardone, or what's his name?
Grant Cardone, yeah.
Grant Cardone, yeah.
I know what his name is, but he, I think, confused a lot of people by making it sound like anybody can just jump into a syndication. So I would really like, since you are the experts, for you guys to say a word about what does qualify somebody to actually be an investor in a syndication deal.
Well, I don't want to diss on my competition at all. So why don't we just lay out kind of what the rules are? I mean, there are 2 types of syndications. There's a 506B and a 506C. And sort of the magic bullet in all of this is whether you're an accredited investor or not. And so if you want to be an accredited investor, which allows you to invest in just about any kind of deal out there, the FCC rules are fairly straightforward. You either have to have $200,000 of W-2 income for 2 consecutive years prior to an investment, or have $1 million of net worth outside of your primary residence that would be liquid. So if you can do one or the other of those, then you're generally considered to be an accredited investor. We tend to do 506B deals. And so there's a little bit of hamstringing on our marketing of the deal because we structure it as a 506B. You're allowed up to 35 unaccredited investors in a 506B, but you're not able to broadcast the deal. Whereas a 506C, I could stand out on a street corner and wave an OM at anybody and say, hey, you want to invest in my deal? So, and the logic is pretty sound. I mean, generally speaking, an unaccredited investor is probably not as sophisticated as an accredited investor. So you worry about the imbalance in the power relationship between the sponsor and the investor. The SEC, I think, smartly puts these rules in place. They're a little outdated. I'm hoping they're going to finish updating them here shortly, but we tend to do 506Bs. It still allows us to market it to all of our deal deck, our database. We have a healthy database of accredited investors now, but it allows us to also bring along friends and family,
Yeah, and I think this is a great argument for referrals, right? Because regardless whether you talk syndication or I talk about the stuff that I do myself or help other people to do in the smaller scale, it's over time you build a reputation and a certain level of credibility, and that then leads people who have actually participated in a deal. Let's just say it's a traditional 5 years, doubled your money. I mean, that word gets out, and it doesn't necessarily only get out to sophisticated or accredited investors. It gets out to whoever is in the communication bubble, so to speak, of the person who had that benefit, right? And so I can
podcasters, for instance.
Yeah, podcasters, but it's also like, I mean, just the people right? And I know during the pandemic stuff, it's gotten a little harder because I at least can say we're not hanging out quite as easily and as much anymore as we used to. But still, the word gets out that somebody made a good deal. It met all the expectations, all the promises were kept. And so now it makes sense to say, hey, and I've had this to myself, and I have a lot of clients who say, yeah, a friend of mine, I would like to introduce you because he asked me what I'm doing. I told him about our deal, and now he wants to come in and see he can participate as well.
And that has happened to us. The interesting thing that I'll point out is there's a dark side to that as well. If you screw up, the world's going to know about it pretty quick. So we're pretty motivated to do well by our investors. And you're exactly right. If we treat our investors well, which we try very hard to do that, word gets out, everybody's happy, we're all making money, we're doing a good social mission on top of it. That's always a nice touchy feeling. And it's a pretty good business model. There's one thing I wanted to rope back into this, go back to a point you made earlier, Axel, but it segues into this really well, which is the illiquidity nature of the investment. It is true that when you invest in a real estate syndication, you tie your money up for a while. Unlike equities in the stock market where you can just place a sell order and be 100% liquid, you can't do that in a real estate investment, and a syndication in particular. It takes a minute to execute these deals. If you're a passive investor in the deal, you're committing your capital to the deal for 2 to 5 years. And so you got to make sure that that's where you want to place your money. It's also, the way I think about it is everybody has opportunity cost to their capital. Mm-hmm. And so if you're evaluating, equities and bonds and a real estate deal, and cryptocurrency is a big deal right now. So a lot of people are like, yeah about that. It's not my thing. But there's an opportunity cost to tying your capital up for 5 years. You can't redeploy that capital. The way we solve that problem, it's really interesting what we do. We not only do we solve the illiquidity problem, but we de-risk the investment simultaneously. And that is, we pull a refi trigger, 24 months into the deal, and we're able to pull a lot of capital out of the asset because we've raised the value of it so high. We're able to give our investors a lot of their principal back. So they maintain their position in the deal while getting their money back, which allows them to redeploy that money. If they get 100% of their money back after 2 years, they're completely de-risked in this deal. So we have solved the illiquidity problem, and there's no risk for them. And this is the only investment that I can think of that provides that opportunity.
Right.
Yeah, absolutely. And it goes to Josh's point about velocity, right? Like, because you get returns, especially when you take the tax implications into consideration.
Right.
I have always said, and there are many more people in the last few years than when I first started, who, when you really add it all together, and you're willing to say, okay, let's at least be fair and say, okay, when you compare the one thing to the other, then you should also look at the same time period, like 10 years or something like that. And as soon as you do that, there's basically no competition, even equity. And anybody in crypto, I don't know if you find that many people right now who are clapping that much when the market is almost back to where it started a year ago, right? But fundamentally, the thing about it is, if you do apples to apples, the opportunity and fundamental safety, if done right, I think is unmatched, right? It's just a lot to understand, a lot to dig into versus somebody saying, okay, I have some mutual fund guy who I just make a payment every month or even through my company, and I never know what my money is actually doing. I just hope and pray that at some point there's something going to come back from that.
Yeah, the other thing about equities or any other investment for that matter is you don't get to use leverage. And we routinely are leveraging everything in our deals. And you just don't get to do that. I mean, $1 invested in equities or cryptocurrency or whatever buys you $1 worth of value. And you're just banking that value continues to rise. And if it does, great. You've now made if it rises 12% a year, you made $1.12. The beauty of real estate is generally 25 cents controls $1 worth of value.
Yeah, exactly.
And then if you double the value of the asset, your returns are off the hook.
I mean, the leverage story, I think, especially in an increasingly inflationary environment, will get better and better for people like us to talk about.
Absolutely.
Right? And so, especially, I mean, always saying, in 5 years, it's maybe not that dramatic unless you are the operator. But when I look at a long-term buy and hold investment in any kind of like single family, duplex, triplex, like what most of our clients do initially, every year then we have 5, 6, and as of today, 7% inflation. And your costs are basically locked in at like 3.8 or 4.1 or something like that.
Right.
It's like you're going to the cash register, so to speak, all the time. So that's really cool. Now, we have been talking. I really enjoy our conversation, but I think we need to kind of wrap up a little bit. And we always ask a few same questions. And since I have the two of you, if you don't mind, I would kind of divvy them up a little bit, one for Josh and one for Mark. So Josh, I give you the one, if you could meet anybody, regardless whether, in the past history or somebody currently around, who would it be and why?
Wow. I guess I'll just have to say Jesus.
Okay.
Because there's so much written about this one man, yet there's so much controversy that's been created over the past 2,000 years that I would just love to actually see what is true about what was written about him and what was embellished. So.
Yeah, and I'm sure there are lots of people who would give you that list to say, what would Jesus say, right? Or what would Jesus say? You can answer all those questions when you... All right, that's cool. Yeah.
WWJS,
So for Mark, the other question that we always like to ask is, if you had a time machine and you could go anywhere, forward, backward, where would you go and why?
Well, I'll give you a multi-pronged answer and I'll try to be succinct. First of all, I've always thought, man, I would love to be 30 years older with all the knowledge I've accumulated across my life. I'd take that in a minute. I really would. All the inefficiency of the anxiety you have when you're coming up and, career building and all that, it would just like go by the wayside and you could just like cruise for 30 years and life's great. And you just have the wisdom to kind of know what is important and what's not. Boy, stuff I worried about when I was younger, I just don't even worry about it anymore. I don't even think about it. So I just would go backwards in time in my own life, I think, and just try to enjoy myself a little bit more. And then if I were to pick a particular era of history, I've always been kind of interested in the pre-modern era, especially in France. I've got an art history minor, believe it or not, and just always enjoyed sort of the Ile-de-France, the area there where all the guys were hanging out in Paris and drinking themselves silly every night. And, Degas was painting all the dancers and all that. So I've always kind of been a little fascinated with that era of history, certainly before all the conflicts of the 20th century.
That's cool. Well, I can kind of see with that degree, maybe you could be like a designer for Versailles, right? Like how do we decorate the walls? Stuff. Okay, yeah, very cool. Thank you for that. So with coming to the end of our time together, if people got intrigued, they say, wow, like 100% of my investment, 2 years in, I get my money back and then just let it ride. How do they get a hold of you to say, hey, could I become part of a deal like that?
Sure. So our company, I wish I had a little thing that flew across the screen.
Nadine can make that happen.
There's mine right there.
Yeah, I know Mark's ahead, one step ahead of me. So we're Three Pillars Capital Group. So 3 is all spelled out like a word. And then my email is joshw@threepillarscapitalgroup.com. So feel free to email. I'd be happy to share with you any information about the company, the deals we work on, and go from there.
Okay.
And you can reach me at SGRE Investments, that's plural, Shuler Group Real Equity Investments.com. And I am Mark at SGREinvestments.com.
Okay, and, wonderful. Yeah, and we're going to put all of that. I mean, this is going to come out both on YouTube and then the different podcast channels. And so we're going to put all those notes and emails and stuff like that.
Perfect.
People. And I will challenge Nadine to make a little thing fly by.
Yeah, fly across the screen. Put wings on it,
Right. Like, very cool.
Say that, if people just want to kick around, we love talking real estate. We're a couple of real nerds when it comes to this stuff. So even if you just want to ask us questions or anything like that, feel free to ping us. And, I'm always in front of this box. I generally respond pretty quick. So
yeah, awesome. And I really want to thank both of you for coming on to the show. The thing about it is what we're trying to accomplish is, yes, we have this kind of niche or this kind of corridor that we are working in with out-of-state turnkey investing, where somebody really like long-term owns an asset and can build a passive income portfolio. But if somebody wants to be even more passive, I think that is kind of what you got across to us today, that working with you, yes, you're making the commitment, but you're basically hiring 2 awesome managers to take care of all the things, keep all the balls in the air and manage everything.
Right. Let us do the work. We'll make you the money.
Yeah, that's actually really cool. And maybe some people can be part of those 35 non-accredited and some are accredited. I know for sure that's the case. So it will be definitely a good thing. So I want to encourage our audience to at least reach out and see if it's for you, and be aware that, like you said, Mark, there's massive leverage in our benefit, in our future, both from inflation and from basically a 4x or 5x leverage that we can apply.
Right.
All right, guys, thank you so much. And I hope we can do it again sometime in the future.
All right.
Definitely.
Thanks a lot.
Thanks for having us.
All right, cool. Thank you. And have a good rest of your week.
All right. You too.
Bye. Thanks for listening, and I hope you enjoyed today's episode of the Ideal Investor Show. More info and the links we mentioned during the show are in the show notes, or you can go to our website at idealwealthgrower.com and sign up for the Apple Podcast link. And if you like to talk to me, sign up for a strategy call. Hopefully you want to share what you learned with your network and bring more people in. We are really eager to hear your comments. And until next time, be well, stay safe, and ciao.